Right now, today, a bank is treating you in a very specific way based on one number. Not your name. Not your job. Not how hard you have worked or how responsible you are or what your intentions are. One number, your account balance. And the gap between how that bank treats someone at the bottom of their system versus someone at the top is not a difference in service quality. It is a different institution operating inside the same building. This is exactly what that system looks like, every level, every number, every door that opens and every door that stays shut, and exactly what moves you from one level to the next. Level 1. Your account is negative. Maybe by $4. Maybe by $400. The number almost does not matter because the mechanism that responds to it does not scale with the severity. It simply activates. The overdraft fee hits within hours, $35 in most institutions. Some banks charge it per transaction, which means if 3 small charges process while your account is negative you owe $105 in fees on top of whatever deficit you are already carrying. The math of this is almost elegant in how precisely it punishes the wrong person. If you had money you would not be overdrawn. But because you do not have money you now have less of it. You try your debit card at the gas station. It declines. You try again. It declines again. There is a line behind you. You are doing arithmetic in your head that you cannot finish fast enough and the card is still declining and everyone behind you is watching. This is what financial stress actually feels like. Not dramatic. Not cinematic. Just a card declining at a gas station while you calculate whether you transferred enough yesterday to cover this. Banks collected over $7 billion in overdraft fees in a single recent year. The majority came from a small percentage of accounts that were chronically overdrawn, the same people paying repeatedly for the privilege of being poor in a system that charges for it. You cannot get a credit card at this level. You cannot get a loan. You cannot get flexibility or patience or a phone call from someone who wants to help. What you get is automated. A fee assessed by a system that does not know your name, does not know you were overdrawn because your paycheck was delayed 2 days, does not know the $47 charge was a gym membership you forgot to cancel. The system knows one thing. Your balance is negative. Everything else follows from that. You are not a customer at this level. You are a cost the bank is trying to recover. Here is how you get out of level 1, because the competitor script never tells you this and it is the most important information in this entire video. The overdraft cycle is a trap with a specific exit. Step 1, switch to a bank or credit union with no overdraft fees immediately. Online banks like Ally, Marcus, and many credit unions eliminated overdraft fees entirely years ago. You are paying $35 per incident at your current bank for a service that is free elsewhere. Step 2, set up a $500 buffer in your checking account as your personal zero. You do not spend below $500. That buffer is your protection against the overdraft fee mechanism. Step 3, cancel every subscription you are not actively using this week. Not eventually. This week. Open your bank statement right now and find every recurring charge. The gym membership you forgot. The streaming service you stopped watching. The app that charges $9.99 a month that you have not opened since February. These are the charges that overdraft accounts, small, automatic, forgotten. Eliminate them before they eliminate your buffer. Those 3 steps move you out of level 1. None of them require more income. They require attention applied once. Level 2. You have pulled the account back from negative. You have $200, sometimes $400, occasionally $600 before rent goes out and it drops again. You are not overdrawn. You are something slightly better than overdrawn, which is to say, you are in the category of accounts the bank services but does not particularly value. The monthly maintenance fee arrives, $12 or $15, automatically withdrawn, because your average daily balance did not meet the minimum requirement. The minimum is usually $1,500. If you had $1,500 sitting untouched in your account the fee would disappear. But because you do not have it, it stays. You are paying for the account that is supposed to be holding your money. Your savings account earns 0.01% annually on whatever sits there, roughly nothing, while the bank lends that same money out at 7 to 24% depending on the product. The spread between what they pay you and what they earn from your deposits is how banking works at every level. At this level you are simply not large enough for them to compete for your business. The service you receive is not hostile. It is indifferent. The teller is polite. The app works fine. There is no relationship here. There is a transaction. You are a number at this level, specifically a small number, and the bank's interest in small numbers is purely automated. Here is what moves you from level 2 to level 3, and it is faster than most people think. The single most powerful financial move at level 2 is opening a high-yield savings account at an online bank separate from your checking account. Right now in 2025 the best high-yield savings accounts pay between 4.5% and 5% APY compared to the 0.01% your current bank pays you. On $1,000 that is the difference between earning $1 a year and earning $45 a year. On $10,000 it is the difference between $10 a year and $450 a year. The bank keeping your money at 0.01% while lending it out at 7 to 24% is one of the cleanest wealth transfers in the financial system, and it ends the moment you move your savings to an institution that actually competes for your deposits. The second move, eliminate the monthly maintenance fee permanently. Either switch to a bank with no minimum balance requirement, or ensure your direct deposit qualifies you for a fee waiver. Most banks waive the monthly fee for accounts with direct deposit regardless of balance. That $15 a month is $180 a year you are paying for nothing. Stop paying it. Level 3. Something changes but not dramatically. Your direct deposit is now $3,200 a month and it hits every 2 weeks without fail. The bank notices, not with a phone call, not with congratulations, algorithmically. The pattern of your account changes from irregular and low to consistent and moderate, and the system responds by moving you into a different behavior category. The credit card offers start arriving. Not the secured card, actual credit cards with actual credit limits of $2,000 or $3,500. The interest rates are still high, 22 to 26%, because your credit history is short and the bank is still pricing risk. But the door is open. The institution that had nothing to offer you 6 months ago is now mailing you things and showing you banners in the app because your income pattern has made you a viable revenue source. You apply for a small personal loan, $5,000 for a car repair. It is approved in 48 hours at 11%. Not great, but functional. The monthly fees have likely disappeared because your direct deposit qualifies you for a waiver. You are a customer now, recognized and serviceable. The bank wants to keep you because you are generating revenue through your card usage, your loan interest, and your growing balance they are lending out at a spread. You matter to them the way a customer matters to a business, which is to say you matter as long as you are spending and you would be replaced without ceremony if you left. Here is the financial framework for level 3 that accelerates everything. You now have consistent income and 0 monthly bank fees. The 50-30-20 rule applies here exactly as described in our first video, 50% to needs, 30% to wants, 20% to future you. But the specific allocation of that 20% at level 3 matters enormously. First priority, build your emergency fund to 3 months of expenses in the high-yield savings account. At $3,200 take-home and living costs of $2,000 a month your target is $6,000. At $400 a month going in, the full 20% of take-home, you get there in 15 months. Second priority, the moment the emergency fund is full, open a Roth IRA and begin contributing. Third, use the credit card you just qualified for on exactly one recurring expense and pay the full statement balance every single month without exception. You are building a credit score with 0 interest cost. Your credit score at leave L3 is probably in the 620 to 680 range. Every on-time payment moves it upward. Every point you add to your score is a point closer to the rates and access of level 4. Level 4. You have been consistent. Not lucky. Not dramatic. Just consistent. The savings account has $18,000. The investment account has another $22,000. The credit card gets paid off monthly, so the 24% interest rate is irrelevant because you never carry a balance. The credit limit increases start happening without you asking, from $4,000 to $9,500 then to $14,000. The bank is extending you more rope because your history shows you do not need it. You pay on time and you do not max out. You are a low-risk high-engagement customer and the bank responds to that profile by offering you more of what you have proven you can handle. The loan rates get better. When you buy a car, the rate is 6.8% instead of 11%. Not because they like you more as a person, because your credit score and asset profile have shifted the risk calculation in your favor. The price of money is lower for you now because you have demonstrated that lending you money is safe. This is how wealth compounds through the banking system even before the wealth is large. Better rates mean you pay less for the same things. Paying less for the same things means more capital stays in your hands. More capital in your hands builds faster than less capital does. The system is beginning to tilt in your favor, slowly, quietly, at the level of basis points and approval rates. If you walked into a branch and said you were considering moving your account, someone would likely attempt to retain you with a better offer. That is a different experience from the automated indifference of level 2. What specifically moves you from level 4 to level 5 is the consistency of the investment account growth. The number that unlocks level 5 treatment is $150,000 in combined assets. At level 4 you are building toward that number. Here is what accelerates it. Every raise you receive, a minimum of 50% of the increase goes directly into your investment accounts before it touches your lifestyle. Your credit score at level 4 is probably in the 720 to 760 range. To push it above 760, which is where the best rates begin to appear, you need 3 things: credit utilization below 15%, at least 3 years of on-time payment history, and no new credit applications for at least 12 months. Do not open new cards at level 4. Do not apply for loans you do not need. Let the history age. Let the utilization stay low. Let the score climb without interference. The bank is watching all of this through your account behavior and adjusting its internal risk model of you accordingly. You are building leverage you will spend at level 5 and up. Level 5. Your combined assets are north of $150,000. Savings, investments, and the beginning of a retirement account growing faster than you expected because you started earlier than most. You are not rich by the standard of what comes later, but you are in the top tier of what most retail banks see daily, and the treatment reflects that. The phone line is different. There is a priority queue for customers at your asset level, hold times are shorter, and the person who answers is more senior with more authority to waive fees, make exceptions, and approve things without escalating. When something goes wrong, and something always eventually goes wrong, the resolution is faster because the person handling it actually has the tools to resolve it. A dedicated banker is sometimes assigned. Not always, not at every institution, but at the better banks a named contact appears who knows your account, emails you directly, and calls to check in. Pre-approved products arrive: mortgage pre-qualification, investment products, premium credit cards with real rewards instead of the 1% cash back that lower-tier cards offer. The institution is beginning to compete for your future business, not just your current balance. They are thinking about what you might become and pricing their offerings accordingly. You are a preferred client now. Named. Known. Flagged in the system as someone worth protecting. Level 6. The definition varies by institution but generally begins somewhere between $500,000 and $1 million in investable assets. At this level the bank stops being a place you visit and becomes a service that comes to you. Wealth management is offered, financial planning, investment advisory, tax coordination, and estate planning guidance wrapped into a single relationship. The conversations change texture. You are no longer being sold consumer products. You are being consulted. Someone is asking about your goals, your timeline, your risk tolerance, and your family situation. Loan approvals move faster. The paperwork is lighter. The rates are better. When you call about a wire transfer that has gone sideways or a fraud alert that has frozen an account you need immediately, the problem is resolved in the same conversation. No callbacks. No escalations. No scripts. Someone with actual authority handles it in real time because your account warrants that level of response. You are an asset to the bank now. Not a customer, an asset. The language in their internal system is different. The protocols are different. The experience is different. And the distance between this and level 2 is not a matter of better service. It is a different institution operating inside the same building. Level 7. Above $5 million in assets, the bank begins offering things that are not publicly advertised. Products that do not appear on the website. Rates that are not posted on any board. Access to investments not available to retail customers because they require accredited investor status, minimum commitments, or relationship history that most people do not have. The interest rate on your mortgage is lower than what anyone in level 3 would be offered, not slightly lower, meaningfully lower by enough over the life of a loan to amount to tens of thousands of dollars in difference. The bank competes aggressively for your mortgage because a borrower at your profile is almost zero risk and the relationship brings ancillary business across products they would rather have than not. Your advisor at this level is not a generalist. They are a specialist, possibly a team of specialists, one handling investments, one handling tax strategy, one handling estate and trust structures. They coordinate, they communicate, they meet with you quarterly in a room that does not look like the room where level 2 customers wait. The room has better chairs and the conversation has different stakes. The rules become flexible, not in ways that break laws, but in ways that exercise every legal degree of discretion available under the bank's internal policies in favor of clients whose relationships are worth preserving. Fees that technically apply are routinely waived without being asked. Exceptions that require manager approval are approved before the manager is formally consulted. Level 8. Private banking is a different product from wealth management in the same way a charter flight is a different product from first class. They both get you there. The experience is not comparable. At this level you do not have a banker. You have a private banker, a title that carries specific meaning inside the institution. This person manages a small number of relationships, sometimes fewer than 20, and their entire professional focus is those relationships. They know your children's names. They know about the foundation. They know WH. At you are trying to build and what you are trying to protect. They have direct access to the decision makers inside the institution who can make custom arrangements that no standard product menu would ever capture. The deals at this level are bespoke. The interest rate on a loan is negotiated, not published. The investment minimum for a private equity co-investment is waived because the relationship justifies it. Documentation for a transaction that would take a retail customer 2 weeks is handled internally in 48 hours because the people processing it have been told whose account this is. The system that was automated and indifferent at level 1 is now human, attentive, and oriented toward yes. You are not a client at this level. You are a relationship. Losing you would matter to people whose careers depend on not losing you. That is a different kind of power than anything else in this conversation. Here is the truth that the banking system is built on and that almost no one explains clearly. Every level of treatment you receive is a direct reflection of the risk and revenue you represent to the institution. The bank is not moral. It is not immoral. It is a risk pricing machine. At level 1 you are a cost. At level 8 you are a revenue center they will bend their own internal rules to retain. The move from one to the other is not luck. It is not connection. It is not who you know. It is a credit score that climbs because you pay on time and keep utilization low. It is an account balance that grows because you automate the savings before you see the money. It is an investment account that compounds because you leave it alone through corrections that feel personal. It is the 50% rule applied every time income increases. It is the emergency fund that means you never need the overdraft protection that costs $35 a transaction. Every single mechanical decision in this video, from switching to a high-yield savings account to automating the Roth IRA contribution to never carrying a credit card balance, is a decision that moves you up one level in a system that will treat you better, price money cheaper, and open doors wider the higher you climb. The system was not designed for you. But it runs on rules. And the rules work the same way for everyone who learns them. Now you know them.